Hello and welcome to Chapter 12. We're just about at the end of the semester. I hope things are going well for you. In Chapter 12, we're going to talk not only about long-term liabilities, but we're also going to touch on a finance concept called the time value of money. Each one of them are related, but we're going to specifically talk about long-term liabilities. As you might recall, we've been kind of going through the balance sheet. My apologies for that thing that came through my email. But we've been going through the balance sheet, and what we're going to do now is we're looking at the long-term liabilities and what it means. Remember, a liability is something that a business owes, and the normal balance is a credit balance. And so we're going to talk first about how we journalize transactions for long-term notes payable and mortgages payable. And long-term liabilities are liabilities that generally are going to be paid in greater than a year or an operating cycle. And for purposes of what we're doing, it's going to be greater than a year. And a couple common ones are long-term notes payable and mortgages payable. Each one of them has a little bit of different character, and those are something that we're very familiar with. The notes payable would be like a car note for us individually, where we pay a certain amount of principal and a certain amount of interest on every payment. And the same thing with mortgage payable. It might be a car or a house note that you pay a certain amount of principal and a certain amount of interest. And you use something called an amortization schedule. Here's the first part, though. Let's look at what SmartTouch did. On December 31st, 2016, SmartTouch signed a $20,000 note payable, and it says it's due in 4 annual payments of $5,000 plus interest. Now, what's critical about that $5,000 is they're going to have to pay interest on the full $20,000 in the first year, but they're going to pay 6% interest on $15,000 in the second year, and 6% on $10,000 in the third year, and 6% on $5,000 in the fourth year. But when they first took out the note, what they're doing is they put it on their books for $20,000, and you have it. So you have a debit to cash and credit to notes payable. I know you're familiar with this part, so we've created a long-term liability. And we have something called an amortization schedule that tells how much a person should pay. And it's basically the interest at the beginning times the interest rate times time. And it kind of gives us a breakdown of what the payments are going to be. So let's take a look at an amortization schedule for this. On December 31st, 2016, the company took out $20,000. That's their ending balance. In 2017, they will have paid off $5,000 when they made their payment in 2017. They'll pay $1,200 in interest because they're paying it on December 31st, and then they'll have a total payment of $6,200, but $1,200 of that's going to go to interest, and the other $5,000 is going to go to the principal balance. In 2018, basically, it's the same thing, and in 2019, you can see that the principal balance has gone down each year. And you can tell that the interest rate, so let's go down to this last one. In 2020, through the entire year, the company owed $5,000. They paid 6% interest on that $5,000. So their total payment in the last year is $5,300, $5,000 in principal to cover this amount, and $3,000 in interest, $300 in interest to cover the amount. So their total interest over the life of that note was actually $3,000. But it's going down each year. So that's a notes payable. And as we made the payment, it looks like this is the payment for the first one in 2017. What we're doing is we're decreasing the principal. Our total payment was $6,200. We're decreasing the principal of $5,000, and we're increasing an expense of $12,000 or $1,200. And our total payment was $6,200, if you recall from the amortization schedule. Mortgage payable has kind of the same characteristic as long-term notes payable. But what happens is with mortgages payable, you typically are going to make a payment to every single month and are secured by a specific asset, whereas notes payable generally are not. So let's look here. So this is a business they bought. Looks like they bought a building. They paid $150,000 for it. They put $49,925 down in cash. And then they have a mortgage payment of $100,000 that they're going to pay out over 30 years. And I want you guys to pay particular attention to this, because this would be something that you might see for your first house. Now you might not have $50,000 down to buy your first house, but your mortgage might be in the neighborhood of $100,000. So this gives you an idea, and we're going to focus particularly on the mortgage part of this particular transaction. And it says here that they're going to have $600 payments starting on January 31st, 2017. But remember, this is for 30 years. So if you take 600 times 480, that tells you approximately how much you're going to pay back on the $100,000. So take 600 times 4 times 360, excuse me, and that's going to tell you how much that you're going to pay back. It's going to be much higher than what you had anticipated. So here is the amortization schedule for a year. And a couple of things I want you to pay close attention to. The first thing is look at the principal amount after the first year. Well, first look at the total payments. After the first year, you've paid $7,200, but you've only paid $1,200 in principal and the rest in interest. So something for the real world that'll help you is if this is you in the early years of a note, if you can pay one extra total principal payment or approximately $1,200, this balance is going to go down markedly faster, and the interest you pay is going to make a difference as well. But this is the schedule you would get because the bank will adjust. If you make incremental principal payments, this number is going to go up, that number is going to go down, and therefore your principal number or your interest number or here is going to go down as well. So I would suggest if this was your home mortgage or if it's a car loan, either one of those two, that you try and pay more than what you owe each month. Even if it's only a little bit, even if you only paid $50 more per month, look, you're gonna have 50% more of what your principal is in the early years of that note. And there's this rule of thumb with mortgages that say if you pay one extra payment a year, so for this one it would be $600. If you paid one extra payment a year, you would take your mortgage from 30 years down to 22. So that's. But let's talk about how the accounting works for this, and it's going to look the same as notes payable. When we make the payment, we're going to deduct $99.62 based off of the amortization schedule out of mortgages payable, and we're going to post $500.38 for interest, and we're going to make the payment of $600. So you can see how, even though you're making a $600 payment, the majority of it is really interest. So if there's ways that you can double this and maybe make this $700, you've doubled your principal right there in and of itself. And it obviously inevitably would reduce your principal or your the amount you owe on interest and the amount of time it's going to take you to pay off your loan. Now, bonds payable is a little bit different than mortgages payable and notes payable in that it's a much more formalized document, and it's long term. And they're issued based off of $1,000 per bond. And if you notice here, these are things that are on the note. Face value, maturity value, and principal amount and par value. And face value is basically what the borrower is going to have to pay back. So they might say they issued $100,000 worth of bonds, but it's going to be in $1,000 increments. So that means they issued 100 bonds for $1,000 each. And if they issued them at face value, that means that they issued them at the value that was on the bonds, or $100,000. And the maturity date is when they must be paid back. And the maturity date can be different, and it could be paid back similar to what we did with similar to what we looked at with notes payable, where you pay a certain amount each month, or it could be a term bonds payable, which we'll talk a little bit more about some of this stuff in a minute. It could be a term bonds payable, which means that you pay it all off at the end of the maturity date. And then you have this stated interest rate, and these are all basically the same. Stated, face rate, coupon rate, nominal rate, those are all the interest rates, different terms you might see used on a bond. And here's an example of a bond. You have the issuing company, the maturity date, how much this one particular bond is for, and then the stated interest rate. So it's basically the holder of that bond is going to get interest of 9% annual. And if this one is a term bond, which I presume it is, they're going to get 9% annual, or approximately $90 from now until 2020. So for the next 5 years, they're going to get $90. And at the end of 2020, they're going to get their $1,000 back. Now, these are different types of bonds. Term bonds, They mature at the same time, so they mature at some point in the future, say 2020. Serial bonds mature in installments and at regular intervals, and secured bonds have something behind them, some type of asset, some type of a building, something like that. And then debentures are bonds that are only based on the creditworthiness of the borrower, because an effective bond is just like borrowing. The difference is that you're not going to a bank anymore. Typically, you might be selling those to the outside. Now, bond prices. Yeah, bonds are going to be issued at a discount or a premium. Well, the first one is at face. Face means that you might see bonds are issued at 100. That means that they're issued at face, so you take the 100 would actually be 1.00 times the face value. So if you had $100,000 worth of bonds and you issued them at 1.0, that would mean that you're issuing them at face. If you issue them at a discount, it's going to be something less than 100, maybe 0.90, they'd say at 95, which would be 0.95 times 100,000. So they're issuing $100,000 bonds for $95,000. And if they issue them at a premium, it's going to be 105, let's say. And so it's going to be 1.05 times 100,000, and it's going to be $105,000. So what that means, let's use this last one as an example. If you issued bonds at a premium, you're going to debit cash for $105,000. You're going to credit bonds payable for $100,000, and you're going to credit an account called Premium on Bonds Payable for $5,000. And this is just an example of what their bond price information would look like. And what we talk about is a present value. The present value of money is money earns interest over time, and it has a future value. And then you have bond interest rates. This is a big thing here. And I want you to look at this stuff on the bottom. It says if the bond stated interest rate, or what's on the face, is equal to the market, it's going to sell at face value. If the bond stated interest rate is less than the market rate, they're going to sell at a discount. And if it's greater, it's going to sell at a premium. Because what that's really saying, the whole idea of this discount and premium is to equivalize the face value of the interest rate on the bond with what the market rate is. So they're penalizing them for this one, because for this middle one where it's a discount, because they're saying, look, on similar bonds, similar risks, I'm getting a 10% return, and on the other ones, I'm getting a 8% return. So when they do that, they are going to report a premium or a discount, as you'll see here in a minute. Now, when you issue bonds, a bond is a contractual obligation to pay them off. It's less expensive than capital stock, but it's now a contractual obligation, and they're required to pay that back. And earning more income based off of borrowed money is called financial leverage. And what happens is the owners of the company prefer actually that you issue bonds more than stocks, because that means there's more money to go around for stockholders if in fact the company has a profit. But it's a contractual obligation for the company if they're unable to pay those off. So there's a risk associated with that. So let's take a look at what the difference is. Here's a little calculation. And you notice here, there's two plans. The first plan says we're going to issue $500,000 of 10% bonds payable. And what happens is we've now created and this is an income statement, so it says that they have to pay $50,000 in interest expense. And the income before income taxes is $150,000. At 40% income tax is $60,000, so it says that their projected net income is $90,000. Project net income is $90,000, and the total net income is $390,000. And if you take, it doesn't tell you here, it tells you the number of shares outstanding for Plan 1 is 100,000, so your return per share is $3.90. The second one, a couple things that are different. You issue stock, you pay no interest, the amount of taxes goes up, and this is just for a special project, and it says that you made $120,000 or $420,000 total, but now you're dividing that by 150,000 shares. So look, the profitability is more, but you're sharing it among 50% more shares. So your earnings per share goes down. That's why shareholders prefer more bond than stock transactions because it dilutes their earnings and their potential earnings. So they would prefer that so long as the company has the financial strength to pay them back. So let's take a look at how journalizing bonds payable looks different and some kind of straight line amortization. So remember, bonds are a long-term liability. You can issue them at face value, which would be like 100 or 1, discount, which would be 95 or 0.95, or a premium, which would be maybe 105, which would be 1.05 times the face value. Discount would be 0.95 times the face value, and face value would be 100 times 100 or 1 times 100 times the face value. And they're a long-term liability. So here's one that we issued at face. You notice it's doesn't say it's at face, but that would tell us it's 9%. It says that the market interest rate and the interest rate on the face value of the bond are 9% of the same. So they issued this at face, so it's 100,000 and 100,000. And then we look at interest expense, and this looks like it's every 6 months. So we're going to report interest expense, and we're going to pay this out to the bondholders every 6 months. And in this case, it was a 9% note. We know that, a 9% bond for $100,000. So we're going to spend out $4,500, and we're going to send a check to $4,500 to pay interest expense for that one. Now, this one's at a discount. This one, because the interest rate on Smart Touch bonds is 9%, but the market interest rate is 10%, we know we're going to issue them at a discount. And it doesn't give us the numbers like I was telling you earlier, but this would be, they issued it at 96.149. So you're going to take 96.149 times the 100,000. The company still owes the 100,000, but they're only going to get $96,149 for their bond, and then they're actually going to have, because what happens is the investors are only willing to pay $96,149 for their bonds because the difference between these two interest rates. So this 3851 becomes a discount on bonds payable, or it means that Smart Touch is actually going to owe, they're going to have to pay back not only this, they're going to pay back as if they had $100,000. But this basically equivalizes the interest rates. And that's a contra bonds payable account. And so when you want to know the carrying amount of the bond, it's going to be the 100,000 less what's in your discount on bonds payable account known to figure out the carrying value. Now we amortize a bond discount, and this is similar to what we saw earlier. We're going to amortize it using, just like depreciation, we're going to look at the straight line method. And it looks like we have, what, 4 years here, or 5 years? It looks like it's 5 years divided by 10. So we're going to amortize that bond discount at $385 every 6 months until we get to the end, until we get back to the $100,000. And this looks like a term note because it looks like they're going to pay that off at the end of year 5. But you're amortizing each one of these, and when you do that, it actually becomes an interest expense. So it's the cash paid out plus the amortization becomes your total interest expense. So if you want to get an idea of what your real true interest expense is, you might divide this times this, but remember you got to multiply it times 2 because it's an annual number. So you're trying to equalize to get to 10% interest. But you can see, and we'll look at the journal entry next. So here's what happens. Your interest expense is the $4,500, which is 6 divided by 12 times 9% times 100,000. That's this calculation here. And then we're taking 1/10 of the discount on bonds payable, $385. We're canceling that out. So our total interest expense is $4,885. And then if we do a premium, it's just the reverse, and it says it's an adjunct account. In other words, it's directly related, but it's not a contra because it has the normal balance is the same, but it's related, so it has to be together with it as well. And that's a premium. Now the premium, remember, is, we're paying 9%. Smart Touch is paying 9%. The market rate is 8%. And now you notice here they give you 104.10. So they're actually paying a premium. They're going to take the 104.10, multiply it times 100,000, and you get So when the Smart Touch issued these bonds, they actually got $104,100 in cash. And what they did is they credited bonds payable for $100,000, and they credited this bonds payable, this premium on bonds payable, $4,100. And if we follow this straight line method again, we're going to take the 4,100 divided by 10, and it's going to give us $410. And then we're going to use that to reduce our interest expense, where they paid out $4,500. In fact, the interest expense is only $4,090, and the $410 is really an offset to your interest expense, because remember, you're trying to equivalize the 8% that the market is versus the 9% that Smart Touch has. And here's an example of that straight line amortization we just talked about a minute ago. And when you get to the end, it says that the carrying value is $100,000, and it adjusts that little by little, little by little. And it has the same kind of character as what you looked at for straight line depreciation. The only difference is this $100,000 would be like the salvage value on straight line depreciation. And now, how do we retire? Retire means that we are going to close out a bond. We're going to sell it. We're going to reissue it. We're going to do something where we're not going to keep it on the books. And what it means is we're going to pay the face value of the note, and we can do it at or before maturity. Maturity date is the last date that you can do it, but you can do it before that. And sometimes they'll do that because the business circumstances change and their interest rates are different. So they're going to do it before maturity because it's better for them to do that. And so here's what happens. Here's one where they retire at maturity and it's at face. So look, all they're doing now is they wrote out the check to the people that held the bonds for $100,000, and they debited bonds payable for $100,000, and they cleared that bond. And if they retire the bonds at maturity, they can have some that are callable bonds, which means that the company that holds the bond may call or pay it off at a specific time. And sometimes it's because they're not making their interest. Well, now here's an example if you do it before maturity. Well, first we want to look at the carrying value of the bond, and I want to talk about this just a little bit because I think it's easier the way I'll explain this. The face value is at $100,000. That means that in your bonds payable account you have a credit for $100,000. You have a debit in this discount on bonds payable of $3,081. The carrying value is $96.19, and the market what they're going to retire it for is $95,000. It has a gain. But I want to go through and look at these the journal entry that's on the next one, and show you what happens. The gain's going to end up being a net credit, but I want to show you each step in the process. Okay, the first thing, we retired $100,000 worth of bonds payable. They were on our books for $100,000, so we're gonna debit it to cancel that out. You have the discount on bonds payable, which remember was a contra bonds payable account, or had a debit balance. So we want to cancel that out, 3081. The other thing we know is we also know that we're going to pay $95,000 in cash. That's a credit. So all three of these, this number, and this number, are known. The only number that we have to back into is this 1919, because we have to make our debits equal our credits. We just have to figure out which one it is. And in this particular case, it's a credit, so that means it's a gain. We've made money. Just as easily, it could be a debit, which meant that we lost money on retiring the bonds. In this case, the company basically had $100,000 of bonds on their books, but the carrying value was $100,000 less the 3081, so it was $96,000 and change, and almost $97,000, $96,919, and they retired them for $95,000, so they made money. And how we look at liabilities on the balance sheet, we're going to separate current and long-term liabilities, and we're going to put the premium or discount in the bonds payable section. So let's take a look here. All these short-term liabilities that we talked about in the last chapter, among others. You see here they put FICA, OASDI. I would call that Social Security, and that one I would call Medicare. And I think it's for, it has to do with disabilities insurance and such. So you have the breakdown of these two, and you have all these different payables that are all short term, which means they're due in less than a year. You notice you have notes payable in both, because you have a current portion of notes payable, and you also have a current portion of mortgage payable and a current portion of long-term notes payable. So you can have both of these in different places depending upon what it is. And you notice on the bottom here we had this bonds payable And then we had the discount on bonds payable, which tells you it's a debit. So the carrying value is $96,919. We'll look a little bit at debt to equity ratio. And what you're doing is you're measuring the difference between debt and equity within a business and what that proportion of liabilities are. In a ratio greater than 1 tells you that the company is financing more assets with debt than with equity. And if you're an equity holder, that's a good thing because that means you're going to get more return on your money. So here's an example. Here's a calculation. And it gives you an idea. And you're looking at, when you look at debt, it's actually total liabilities. And you can look at it for 2013 and 2014. And what you find is for 2013, it's 0.43. And that means that they're financing a whole lot more of their assets with equity than they are with debt. Good thing for a financing. Now, just real quick, I want to touch on this because I think it's important you guys to know just a little bit about the time value of money. I'm not going to spend a bunch of time here, but I want to spend just a moment with the time value of money. The time value of money says that $1 received today is worth more than $1 in the future. So if I were to give you a choice, I'll give you $10,000 today or $10,000 5 years from now. You would take the $10,000 today because the $10,000 5 years from now isn't going to be worth as much. And because you invest that money and make interest. Now, let's talk about a simple example. Let's say you won the lottery for $20 million. Well, what it actually says on the back of the lottery ticket is it says that they're going to pay you $1 million a year, $1 million per year for 20 years. Do you think that the $1 million in year 20 is worth the same as it is today? Absolutely not. It's going to be worth a whole lot less. And we can use that for bond prices. I'm not going to spend time on the bond prices, but I just want to get you introduced to this because these are really finance functions applied to accounting. So you have the time value concepts. You're going to look at a lump sum or an annuity. A lump sum is $10,000 today or $10,000 5 years from now. And then you're going to look at some type of an interest rate. The N is the number of periods and the interest rate is the other part. And then you look at simple interest versus compound. Simple interest means that it's only on the principal amount, where compound interest is on the principal plus the interest, so it adds on top. That's the difference between the two. And here's a simple interest calculation. It says that they're only going to pay interest. This is simple interest on the left. They're only going to pay interest on the simple calculation, and over here they're going to pay interest on top of interest. So in year one, and every one of these for simple interest, they're paying 6% on it all the time. Whereas over here they're going to pay that 6%. Then they're going to pay 6% on the new balance, and then the new balance, and the new balance, and the new balance. So with compounding interest, it's going to get you more money. And these are obviously some rounding stuff here. And if you look at the present value of a lump sum, I'm not going to go into the calculations of this, but you'll see there's some factors from a table in your appendix. You want to go look at this. It'll give you an idea, and this is a lump sum, and it's saying, okay, what's the future value? The future value is the amount that you would get in the future, and it looks like it's at 6% in 5 periods. So it says in 5 years, or periods, what it's going to tell you is you have 6% interest. So what would it be worth today? So $13,383 would be worth approximately $10,000 today. $13,383 5 years into the future would be worth $10,000 today. And then you have an annuity. Annuity is a stream of money, the exact same amount over a period of time. And what this one is saying is $2,000 paid out at the end of the period, every period for 5 years. At 6% interest would be worth $8,424 in today's terms. This would be like the lottery example that I talked to you about earlier. You would say, if I wanted the $20 million lottery, how much would it be worth today if I took the lump sum today? And that's what you hear. They'll say, well, they took the lump sum and then they add on to that net of taxes. So you might win $20 million, but it might only be worth, say, $8 million today, because you're taking money from, say, all these annuities, it's even amount of $1 million each year for 20 years and bringing them back into today's dollars, and you're paying taxes. I'm introducing this to you because I think it's important for you to see this several times in your academic career, but I wanted you to just spend some time with this. That's the end of chapter 20. and excuse me, at the end of chapter 12. I hope that you got a lot of this, and I'll see you again in chapter 13. Have a good day.